Ladies and gentlemen, good day and welcome to the Container Corporation of India Limited Q4 FY23 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital Advisors. Thank you, and over to you, ma'am.
Yeah, thanks. Good morning, everyone, and a warm welcome to the Container Corporation of India's Q4 FY23 earnings call. We have the management today being represented by Mr. V. Kalyana Rama, Chairman and Managing Director, and his entire senior team. I'll now hand over the floor to Mr. Rama for his initial remarks, and post which we'll open up the floor for Q&A. Over to you, sir.
Thank you, Bhumika, and good morning to all of you. Thank you for joining in the conference call and to share our views on our business and the future. Last year, we could achieve around 7% growth in our volumes. Even though EXIM, yes, there is a strain on volumes in EXIM. We are facing some headwinds. We are working on them. So let me share with you, some customers are taking some positions because of the continued uncertainty going about the divestment, but then we found the solutions for that, and we are positively getting response for that, and we are working on that. Very interesting thing which happened in the EXIM sector is the direct connection to Dadri for the DFC. So that has enabled us to run the double stack train direct from Dadri into Mundra and Pipavav, and the time taken is less than 24 hours. So a lot of diversion of road cargo to rail we are expecting in that, even time-sensitive cargo, light cargo. We also started the movement of reefer containers and double stack from Dadri. That's a new thing we started. So with all these developments, this year we will be able to withstand the headwinds in the EXIM cargo. Domestic, we are doing very well. This is the third year where we could see a good growth in domestic. On revenue side, we grew by 25%. On the volume side, by almost 15%. This year also, we are working out to grow in the same manner. Maybe our targets are very high, but there are certain constraints in that. The main constraint is the container availability, because we stopped importing from China and we are developing Atmanirbhar Bharat. We released 19,000 containers manufacturing in India, but the ecosystem development is still taking time. So the container manufacturing is not going at the pace which we expect and which we want. So there is shortage of domestic container. As of now, we are able to maintain our supply lines, but to grow faster, we require more containers. So we are working on different aspects, like getting some containers on lease. We are working on that, and also we are releasing further orders for container manufacturing to get the interest that was generated in more and more manufacturers. So there are a lot of effort is going on in this direction. Wheel and axle cargo, there is an issue availability in India. So we are working with railways and we are with other manufacturers for developing these wheel and axles, and to get rakes rolled out from wagon manufacturers. So that also we are working on. Of course, these two constraints will be there in the towards the growth, but we are hopeful that we will be able to overcome these constraints. And with that, the domestic growth we expect this year to be very good. And EXIM, the export-import scenario is one worrisome factor, because the economies in the Western world and the other places are not very encouraging. The commentary is what we are hearing. There is the issue of recession is also people are talking of. But the domestic side, India is growing, and if the EXIM scenario increases, we will get more growth. And as of now, in EXIM volumes, we are trying to get more share. Our share is getting affected. That we are working on to recover back that share, where we were. And this double stack operations and other schemes which we are coming out, like the existing schemes which are running off 50% discount on empty repositioning from port to hinterland, and 1+1 scheme we introduced last year. We are seeing a lot of good tailwinds in that, so we will be able to get some more schemes coming out with those schemes as the things progress. So as of now, I am not very much worried about the scenario for the next financial year, even though that task is very tough on the EXIM side. But I am hopeful that my team will be able to come out with new things and will be able to withstand all these pressures, and we will be able to get that growth, which we always start with around 10 to 12% growth for the year. This year also we are starting our financial year. We started with the same assumptions and we are working towards that. The rest of the things I will answer as the conference progresses. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. The first question is from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, good morning, everyone. Thanks for taking my question, sir. I have two questions. The first one is on CAPEX. In the last Concall, you rightly indicated that CAPEX would be back-ended, and we have seen CAPEX increasing in Q4. So if you can just highlight the main areas of CAPEX last year in FY23, and how much CAPEX can we expect in FY24, and in what areas? That is the first question, sir.
Yeah, DPS, certain projects will answer your first question.
Yeah, as far as the CAPEX is concerned, we have got investment into going into terminal, the rolling stock, that is wagon, procurement of containers. So we have 4 new terminals last year, and we are hoping to commission another 4 terminals, another 5 terminals in FY24. For rolling stock, we are expecting to add anything between 24 to 36 trains in FY24. So that too, we are expecting a CAPEX of about 600 crores in FY24. This is we have got 560 crores last year.
So 560 का breakup किसने ज़्यादा वो पूछा?
In 560 crores, the major investment has been made in rolling stock related activities. Although we have not got the rolling stock physically, we are expecting them delivered this year. But we have invested in getting new wheels, the rolling stock components, manufacturing activity, and axles. So the major part, that is about 300 crores, we have spent on rolling stock alone.
So this year also, the major portion of the CAPEX expenditure will be on the rolling stock and the handling machinery.
Okay, that's very clear, sir. The second question is on margins. Now, if I look at your margins from Q2, margins have gone one way down from 25% EBITDA margin, I'm talking about, to 20.4% in this quarter. And since you have highlighted that actually there is there is a strain on EXIM volume. So, while I'm not asking you to crystal gaze and tell us the margins, just wanted to get what kind of EXIM growth are we targeting, and what kind of empty running cost was there in this quarter?
See, as I mentioned in my comments, I try to achieve the 10% growth in EXIM volume also. So as I already mentioned in my inaugural remarks, that the DFC running now is going to help us. So that is where we are putting our cards, and we are trying to work on the positive impact which it can bring on. So to start with, we will work with the 10%, but things are not very encouraging in EXIM. EXIM actual export-import scenario itself is not very good. The Indian exports are under strain. Like handicrafts are not going, merchandise exports are less, except primary agro exports, other exports are less, and a lot of empty container inventory is building up in India. It's one way is good that export freight rates have come down, but the export scenario is not good. That is why the empty container the inventory is increasing. So now coming to, as I said, even though exports may not increase, but the existing EXIM volume, our share has come down. In the last year, we lost some percentage share. Now we are working up to regain that share back. So that is the main thrust area this year we are concentrating. So we will get back our share, so that will increase our EXIM volumes. And also we are working on increasing our margins by improving more and more double stack. So there is a possibility of increasing double stack because now directly. And also domestic we are trying to bring into double stack operation. This is a new thing. So that, because now we got two hubs on DFC. One is Swaroopganj, that is near Palanpur, and then one in Dadri NCR. So between these two hubs, the distance of around 650 kilometers, we are working on bringing even domestic onto double stack. That will also increase some margins for domestic as well. So these are all the things we are working on. So this is a continuous improvement process we keep on doing. So with that, maybe we will be able to maintain our margins.
Okay, great, sir. And the empty running cost in this quarter, EXIM and domestic?
Empty running quarter का पूछा 94 crores. 94 crores इसमें domestic is 87 and EXIM is 7.
Great, sir. Thanks a lot and all the best.
Thank you. The next question is on the line of Deepak Krishnan from Macquarie. Please go ahead.
Sir, I just wanted to understand, you said you've lost market share. So maybe could you share the overall market share number at the end of the year? And also port-wise, where are you in terms of market share at Mundra, JNPT and Pipavav?
I am Director Domestic, Mohammad Azhar Shams. Could you please repeat your question? Do you want to know the port share of Concall or what share you are talking about, please?
So overall share in rail, like you've indicated, you have lost share. Last quarter, you indicated you were at 58%. So I want to know in the CTO market, what is Concall share? And individually at JNPT Port, Mundra Port and Pipavav Port, what are the market shares? Like last quarter, you had indicated about 79% at JNPT, 38% at Mundra and 48% at Pipavav. So similar number.
Actually, this overall share of Concall combined together, if we talk about the whole of this containerized movement taken place.
Only in EXIM, sir.
Port shares have been not readily available because Director International Marketing Sanjay Swarup is not here. So you send that by email, we will answer you.
Sure, sir. Maybe then just wanted to understand there has been a substantial jump in other expenses this quarter. Has there been any sort of one-off cost or any factor that has caused, because our segmental margins are quite strong, but unallocable expenses are
Yes, will answer your query.
No, you are talking about other operating expenses?
Yeah. So I can just give you the number as well in case that sort of helps you.
So in other operating expenses, there is not much that we have enhanced, except for the fact that in a TKD depot, there was some MCD tax issue was there. And in Mulund depot, there was some that was made for dispensing with some hazardous containers. These are the two culprits. Because of that, we have taken some hit in that area. The rest, it is as usual.
But if I look at, so sir, it's not just other operating expenses, other expenses as well, which is closer to about 103 crores this quarter in standalone versus 59 crores, about 59.78 crores the previous quarter. So Q-on-Q, there's been a doubling, whereas, revenues at a similar level.
No, in other operating expenses, from 138 crore, we have gone down to 134 crore. And in administration and other expenses, yes, from 268 crore to 312 crore, that is 40 crore that we have gone up. Right?
Yes.
So this 40 crore breakup I told you, there are around 10 crores that we paid at Tughlakabad depot for MCD taxes that were, some dispute was going on, and under the court order we had to pay that. Apart from that, there is some repair and maintenance work we have taken heavily in our depots, that is costing us 15 crores. 6.74 crore has gone to the Mulund depot, as I mentioned to you, for disposing some hazardous materials. And CSR payment has gone up by 5 crores in this FY. And there is something we are doing in this bulk cement business, where we have booked around 2 crores. So that quantifies for nearly 40 crores of expenses that has gone up. But if you look at other operating expenses, there we have gone down from 138 crores to 134 crores.
Yeah.
Yeah.
Maybe just one, if I can squeeze in, could you just share your originating volumes for the quarter?
Volume?
Yes.
Okay.
The originating volume.
So for it is 1.1 lakh, 19 lakhs 18, sorry, it is 19 lakhs 18,079 for FY, and for domestic business it is 4 lakhs 40,878.
Sure, sir. So could you just repeat that again? 19 lakhs?
19 lakh 18,079. That is in EXIM originating volume, and the domestic is 4 lakh 40,878.
Sure, sir. So those were my questions, and thanks for the opportunity.
Thank you. The next question is on the line of Atul Tiwari from Citigroup. Please go ahead.
Yes, sir. Thanks a lot. So just wanted to get your views on the margin profile for domestic business, and the context is that there, obviously the company has done very well, and now on a per TU basis, even at this level of volume, it is almost similar to EXIM. So margins have really expanded. So if the volumes ramp up from here, can we potentially look at further expansion in per TU EBITDA of domestic business, and can it even go higher than EXIM?
See, Atul, ये जो domestic margin per TU we are trying to improve upon, but they are always not comparable to EXIM volumes. See, EXIM में every movement is paid for us, because we undertake movement on behalf of the shipping line or other customers. In domestic, if there is an empty repositioning, it is at our cost. So that is where actually we take a hit on our margins. So always our endeavor is to reduce as much of empty running as possible. But as the business grows at a faster pace, there is always an inherent empty repositioning involved in this, till we get a better circuit built up for the new business we are getting. So this is the margin expansion cannot be much faster. In fact, to improve our margins in domestic, what we are working on is we are adding value-added service. So value-added services in the form of first mile, last mile deliveries, business support solutions, and distribution logistics, which I am talking of for last 4 or 5 years now. To start off as early as possible. That is a total asset-light business. So with these things, we want to improve our margin for domestic business.
Okay, sir. And sir, just the second question on the EXIM originating volume. So the number that you gave, 19 lakh 18,000 for this year. If I look at the history, we did the similar number, say in FY15 also. So almost 7-8 years. And, it has been kind of flattish. So, what is the strategy to kind of grow these numbers from here?
You can't take 116 and 123 and say flattish. There was a growth in between. Now it has come down actually. I already told you, we lost some market share. There is a lot of competition for us and the uncertainty of divestment. Some customers are taking some positions. Okay, so this actually, we lost some volume of Exim in the last year. We lost our market share. So we come out with a new scheme in the month of November, 1+1 scheme. So after a threshold volume, if anybody offers us one loaded container, we'll move on empty container free. So that is one scheme which has been taken up by all my customers very enthusiastically, and the volumes are increasing. We are already continuing our empty repositioning scheme. So we are now working on coming up with some new schemes. As I said, reefer containers we put onto double stack. We are going to come out with some scheme with reefer containers. So these are all the things which we are coming out to withstand the competition and also to overcome the uncertainty problems which we are having for 4 years. So we are working on that.
Okay, sir. And sir, finally, very quickly, could you say the domestic originating volume number again? I missed that, sorry. Domestic originating volume.
इधर से ना आप लोग मेल भेजो यार, इसमें don't waste the time.
Okay. Okay.
Mail भेजो, आप लोग reply करो. Can we go to next question, please?
Yes, sir. Thank you. The next question is from the line of Abhishek Ghosh from DSP. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So just wanted to, just on the market share loss part of it, just wanted to understand one thing. Is it because of supply addition, terminal addition by competition, or is it a pricing strategy that has been taken by competition that has led to market share loss?
See, both are there. Both play a factor because the competition pricing strategy is Concall minus. So there is no pricing strategy. If I say my price is X, they will say X minus 3,000.
Okay.
So, and competition is not the other people operating on the rail alone. So we don't see that as a very big competition. Competition is road as well.
Okay.
Road network is improving, a lot of expressway are coming up, and the things are moving very fast. So we have to match that.
Okay. Okay.
These are the two factors affecting.
And sir, since you also spoke about the market share loss in the last quarter as well, is it fair to assume that the market share loss has now at least got arrested and it will be stable now? Is it fair to assume that?
In fact, you can assume positively. See, think positive. That is the essence of life. So what we are working on to get more market share.
Okay.
And to stabilize the market share.
Great. And so just one last thing on the domestic part of the business is how has been the traction on the cement part of this thing? If you can just enlighten us with that.
See, we did handle around 3,700 or 3,800 containers last year. So last month, in the month of March, we touched 800. So there is a lot of interest. Now the things are stabilized. So, but there is, that is a major issue. So we are not really pushing it very fast. We require 25,000 more containers, but India container manufacturing industry has yet to pick up. So we are working in a balanced way.
Got it. Okay, sir. Thank you so much for answering my questions and wish you all the best. Thanks.
Thank you. The next question is from Ankita Shah from Ila Capital. Please go ahead.
Yeah, thank you for the opportunity. So my question is on LLF. What would be the LLF amount this year, FY24?
So, you want to know what you paid this year or what you are expecting to pay this year? What is your question?
Expecting to pay this year, 24.
So actually you can see that on actual basis, if you recall our concalls in Q1 and Q2, where you mentioned very clearly that for the FY22-23, we were paying on actual basis because by the time we had got all the rates of the land. So last year we ended up paying around 392 crores. So you just add 7% on that. So that comes out to be something around 430 crores.
Okay. And no more adjustments to the number or the land terminal that you have is not required.
As we disclosed to you last time also that we have already made provisions of around 70 crores with us. So by and large, most of the places we have already reconciled the things with the Indian Railways. A few parcels are still there, but we have got enough customers with us to take.
Sir, sorry to interrupt. You're sounding a bit distant, sir. May I request you to come closer to the speakerphone?
Okay. So what I was mentioning that we have got enough cushion with us in provisioning in FY22-23, so 21-22. So that provision is already there, and we are on the mode of reconciling things. Most of things have been done with the Indian Railways. And the few cases where if any further payment is required to be done, provision already exists. So in this FY, whatever we are required to pay is on actual basis, that is 392 plus 7%. This is what we are planning to pay. I hope I am very clear.
Yes, sir, absolutely. So secondly, on the realization part, do we see more pressure on the realizations for the EXIM, and what about domestic side? How much should we take that going forward?
I think Ankita answered this question now for 2-3 guys.
Sir, on the realization part, you mentioned about the market share and the
margins also. I said margins also there is a pressure, so that is what realization, isn't it? So margin there is a pressure on EXIM because we will be trying to get our market share back, so we will be coming out with schemes. But that pressure on margin we stand by improving our double stack operation from Dadri and try to reduce more and more empty running. In domestic, as I said, the circuit building which we do, as we add new traffic, there will be more of empty running. Then we will start scout for more traffic in the reverse directions, and we build the circuits. And also we are adding value-added services.
Got it. Lastly, just if you can share the double stacking of trains that we run in this year.
We did last year 4,100 double stacks compared to 3,750 a year before.
Okay.
This year we are trying to bring domestic into double stack, so our aim and my target to my team is that we must cross 5,000 double stacks this year.
Okay. Okay, thank you.
Okay.
Thank you. The next question is from the line of Abhishek Nigam from B&K Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity. So if you can just update us on the 5 new terminals, where are they coming up, and will they commence operations in FY24 or 25?
Yeah, we are coming up with one is there in Jajpur. You know the Kalinganagar steel cluster, that a very large steel cluster. Then the second one, we have got one on competition, one Mandalgarh. Then we are building the Barnam commission, which has been notified, but it will be connected to DFC on the other side. Then we are also planning a terminal on south of Delhi, for which the land acquisition is under discussion with the Haryana government. Then another terminal we are trying to have in Punjab. So about 5 terminals we are planning for FY23-24.
Okay, so 24-25.
Right? These are for 23-24.
So, okay, calendar year 23-24.
Yes.
Fair enough. And just on the DFC, if you can, whatever latest updates, if you have any thoughts on, especially for the final connectivity for JNPT.
Yeah, no.
That you have to ask DFCCL.
Okay.
Yeah.
Okay.
You ask DFCCL, okay?
Fair enough, yeah. Okay, thank you.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Good morning, sir. Thank you for the opportunity. My first question was, what is the contribution in terms of the volume sourced by our associates or trade partners, which is coming on to our rigs for FY23?
What is that? Associate trade partner. Who is that?
Associates or trade partners who are sourcing the volumes and using our rigs for the movement.
So we call them business associates, BA.
Yes.
So domestic
BA.
volume it's except corporate customers, everything will come through BAs only. So the volume will be something like 60% is through BAs. Hello?
Richard, can you hear me?
Mr. Lohar, yes.
So 60% of domestic volume is through associates.
Sorry, sir, I couldn't hear in between. You said 50% of the domestic volume is through business associates, right? Have I got the number right?
60%.
60. Okay. And how about EXIM, sir?
EXIM, there is no associate. No, EXIM it is, booking at the terminal. There is no concept of associate in EXIM. Where from you got this concept?
No, I'm just asking, sir. Domestic, I was aware, so that's why I wanted to know the percentage.
No, in EXIM it is, directly the CHAs, the exporters, importers. In imports it is entirely through shipping lines. All the imports, shipping lines are our customers. Shipping lines directly give us the volumes. On export side, now the scenario is shipping lines offer at some places, CHAs offer at some places. There are some places where directly customers are offering. It's a mixed bag.
Understood. Sir, sorry, I'm hopping on the market share question. Is the market share loss at a particular port terminal or is it at a particular pocket, ICD pocket? Can you clarify a little bit on that? Or it's across the board, sir, in the EXIM segment?
EXIM segment, basically the competition which we feel is on the this western sector, particularly Mundra and NCR sector. So that is where the competition is really tough and where we lost some market share. We are working on that.
Got it. Sir, just a margin guidance with respect to EXIM and domestic for the full year, sir. That's about it from my end. Thank you.
Margin guidance, as I said here in my opening remarks, we will try to maintain the same margins.
Of fourth quarter. Have I got it right, sir?
What we have seen this financial year.
Financial year. Okay, sir.
We don't work on quarter, no. So that you people try to do it. Because, see, long-term investors I got, they don't bother about quarter-on-quarter performance. They look for the next 5 years performance.
Absolutely, sir. Thank you.
Thank you. The next question is from the line of Priyankar Biswas from Nomura. Please go ahead.
Thank you, sir, for the opportunity. So, sir, my first question is, as you had indicated that the number of double stacking will increase from 4,100 to around 5,000. So, if that happens, to what extent should our EXIM profitability should go up?
So, sir, look, I am not an analyst. As I said in many conferences, you people are listening to me for the last 7 years. I don't do these guessworks. You see, there will be definitely increase in margins. Now, what percentage, how many basis points, that we don't know.
You are guiding for same margins in EXIM.
I said yes, because there will be, there are factors we are getting affected by the competition, some headwinds against us. So we are working on, maintaining the same margin in logistics business what we got for this financial year is itself a very tough task. And the margins at this level, logistics business is very tough. I don't think any other logistics operator are coming out with these margins.
That's true.
Yes. Thank you for accepting.
So, sir, and one more thing is, sir, you have been highlighting about the first mile and last mile to improve the services to your customers. Yes. So, at this point, how much of a network, like in terms of terminals, do we have this full first mile and last mile coverage?
See, we got now almost all terminals covered under first mile, last mile. Okay? So, and growth also is very good in that. So, like last year, we handled almost more than 500,000 TEUs. So, our target is 50% we handle. Something like we handle originating volumes of 2.2 to 2.3 million. So, we want to handle almost 1 to 1.25 million TUs under our FMLM in this or by the next financial year. That is our target. We are working on that. And moreover, to improve the productivity on the FMLM side, what we are trying to do, we ordered 100 LNG trucks. Order is already placed. In fact, if you people followed Honorable Transport Minister Sri Nitin Gadkari ji, he mentioned in one of his speeches that he inaugurated the first LNG truck from the Pune company. So that is where we placed our orders, 100 LNG trucks. So these LNG trucks we will be introducing, and we will be putting our LNG station in our own terminal. We are already tying up with the oil companies. Their oil companies are also very much interested. So once we start with this, when we experience this for 2-3 months, then we will proliferate this across all our main terminals with LNG transportation. And let me tell you, the LNG transport will be at the 50% cost of diesel transport.
So the running cost would be like 50% lower for the LNG trucks, so something like that.
Yes. So that is not 50% of the cost. There are other costs. So the fuel cost in the local transportation is something like you can account it for 40 to 45%. So you will save at 25% of money in the local transportation.
Okay, sir. And sir, just if I may squeeze just one more in. So your double stacking has risen very sharply, like FY23 versus FY22. But the increase in profitability in EXIM is sort of range bound. I mean, is there any other factor that we need to be aware of, like what is like preventing the EXIM margins from going up? I understand it's one of the highest in the industry, but still.
See, the empty running cost, railways, you were giving 25% discount on empties in 21, 22. Now last year it is withdrawn. And then there is a 5% reduction in the load run. That is reduced, but we have not increased our rates. So we have absorbed these costs, 25% in the empty. Not that, when I say empty, it is not only empty rakes, empty container movement as well. And all that 25% cost in domestic as well as in EXIM also we absorb. And 5% increase in the loaded runs we absorb. So these are all the pressure on the margin. So that is where we could maintain our margins only with a little bit of pressure on margins because of our improved double stack, improved operations, and faster turnaround of rakes.
Yes, sir. That's very clear, sir. Thank you, sir.
Thank you. Any participants who would like to ask a question at this time, they may please press star and 1 at this time. The next question is from the line of Mukesh Saras from Avendus Spark. Please go ahead.
Yes, sir, good afternoon, and thank you for the opportunity. My first question is again on the market share bit. You had commented that road transportation is also getting extremely competitive. Sir, with the backdrop of double stacking, DFC, timetable trains, we would actually expected the opposite, where rail would have gotten a lot more competitive. So just trying to understand what are the reasons that road is also gaining share over rail or getting more competitive?
Have I said that road is gaining share?
No, I mean, okay, it is competitive, because of which it's probably impacting your margins or market share.
Competition is a word that means road is not giving up. So as we are improving things, there are the improvements in road also. There are expressways coming up. See now Delhi-Mumbai expressway. Honorable Ministry is talking of moving in 16 hours from Delhi to Mumbai.
Right.
Yeah. So when I say competition doesn't mean that and they are gaining.
Okay.
Now that you should never understand like that. Competition means they are also equally improving things. So we have to keep on improving our things to maintain our share as well as our margin.
Right, but is it fair to assume road has not lost share, sir? Because in the last 2-3 years with DFC and double stacking, we had assumed there will be a movement from road to rail. Is that happening or not?
We gain share. Now, See, I don't maintain the entire All India statistics. So these figures we have to see. Whether how much road has gained, how much rail has gained, so we have to see. But definitely we gained some traffic because of the double stack running we are doing and the domestic, the DFC connecting to Dadri now happened this year. So this year we are definitely expecting more volumes to come to us when we are seeing the traction. You see, when I tweeted on my handle about the the connection of Dadri directly into Mundra, it got a number of hits. There's so much of interest in that.
Okay. So we should assume that probably with more connectivity now, there could be an inflection point. We could gain a lot more share from road going ahead, sir.
You are a bull or a bear? Tell me, then I will tell what you say.
No, but on the ground, you would be a better. You would give a better.
Definitely, why? We see from Dadri to Mundra now the container is moving within 24 hours.
Sure.
So no road can take this to 24 hours to Mundra.
Right.
Even with all expressways. Now JNPT connection with the dedicated freight corridor, I can't comment on that. Once it happens, then we will be definitely compete with the Mumbai-Delhi expressway.
Sure.
The Mumbai-Delhi expressway, somebody is talking of 16 hours, that is for a car. If somebody is driving without non-stop, that is so truck will take maybe 30 hours if you go with a double driver. So then there is always the rail. The dedicated freight corridor will reach within 24 hours to JNPT. So these are all the improvements which are coming in rail sector. They will be competing with the road. So road is giving competition. So rail also has to keep on improving things.
Got it, sir. Got it. Thank you. And secondly, sir, what is the rail freight margins in this fourth quarter?
Rail freight margin? 26%.
26%. All right. And lastly, the lead distances, if you could give for both domestic and export.
Well, lead distance are almost same. For the lead distance, you want to know for what? For the quarter?
Yeah, for the quarter, if you could.
Quarter, it is 657 in EXIM and 1382 in EXIM. 1382 in domestic. 657 EXIM, 1382 domestic.
Sure. All right, sir. Thank you so much for this. Thanks.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead.
No, my just questions are answered. Thanks.
Okay, Vikram. Right. Thank you.
Thank you. Next question is from the line of Raghavendra Rathod from Dolat Capital. Please go ahead.
Yes, so I just wanted to know that the capex plans that we had at the start of FY23 that we would be spending around 8,000 to 10,000 crores in the next 3 to 4 years. I think this year we won't be on track due to the domestic ecosystem. So what is in the medium term, is the plan still on for the capex?
The plan is on. We will be spending that money because our plans to acquire 70 rakes. In that we got now 33 rakes. The remaining rakes we will be acquiring in next 3 to 4 years. We are working on the ecosystem. So there is a 237 rakes left over. Each rake put 14 to 15 crores. You calculate. You take down your pen and paper, note down these numbers. We want to increase our domestic containers, our holding of containers over next 5 years to something like a 1 lakh to 2 lakhs, depending on the demand. Now each container put 4 lakhs, calculate yourself. So our plans are there. So now we have to develop the ecosystem. Then the capital expenditure will take. That's what I said. You see, quarter on quarter our investors are not looking at. Our investors are looking at what in the next 5 years we are going to do. In next 5 years our plans are intact. As I mentioned that 8,000, 10,000 crores we will be investing into the rolling stock, into the terminals, into various other things. It is still there and it will happen.
And sir, what would be your guidance on the additional benefits of this capex in the medium term on our top line?
My guidance for this financial year, we will try to maintain our margins. We will try to grow at 10%, what we always aim at, and then we'll see how things will roll out. So there is no guidance I can give you beyond 1 year. We don't give that guidance.
And sir, the EBITDA margins in this or sequentially have contracted. So is there any one-off, or what are the reasons behind it?
The EBITDA margins, already that one-off question our DF has answered. It's very less, very small one-off we did, so there is not much of one-off. There are pressure on margins, and we will be working towards maintaining the same margins as this FY for the this current FY also as the previous FY.
Okay, thank you, sir.
Thank you. Any participants who wish to ask a question?
Sir, if there are no further questions, yes. I think Bhumika can end the day. What, Bhumika?
Sir, we have one follow-up question. Can we take that?
Okay.
Yeah, that is from Achal Lohade from JM Financial.
Yeah, thank you for the follow-up, sir. Sorry, I'm just wanted to know, in terms of market share for the full year for domestic and EXIM, if you could specify, sir. I know you said the market share is not available, but just a ballpark contraction. How much is the contraction in the EXIM for full year?
Mail. You want figures? See, you want to know the policy and the trends, I think I can comment. If you want to know exact figures, what I suggest you people send mail, my secretarial branch will reply you back.
Sure. Now, just another statistics with respect to the rail coefficient and the port mix.
Again, you want numbers or you want the trend?
A trend, if you would specify numbers, I will send an email.
We lost some share. In rail share, we lost some share in the EXIM segment. In domestic, we are doing very well. In EXIM market, we almost command 90% share on the containers which are moving by rail. But in EXIM segment, we lost share, where we are working on to gain back that share.
I meant rail coefficient at ports, sir, or aggregate ports. If it is 22%, it is improved or declined or anything of that sort.
Figures. I told you, you send mail, you get figures.
All right. Sure. Thank you, sir.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Ms. Bhumika Nair for closing comment. Thank you, and over to you, ma'am.
Yes, I would like to thank everyone, and thank you to the management for giving us the opportunity to host this call. Thank you very much, sir, and wishing you all the very best.
Thank you, Bhumika.
Thank you. Ladies and gentlemen, on DAM Capital Advisors Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.